Right, good evening, ladies and gentlemen. Again, it's a pleasure. This is my second live event that I've done since COVID, and it's great to see everyone in person. So, for those that I believe that there are some Cadence shareholders in here, I'm going to go through the presentation, focus on some of the latest developments that's happened, and what we can expect going forward, and some of the sort of insights that we're seeing, especially, again, lithium is coming to the fore and the importance of that in the electrification of vehicles. Disclaimer, I think there was one beforehand, but this is on our website. Please feel free to read it at your leisure. So, look, this is Cadence's investment strategy, and I think you've seen this on our website, you can review it, but in essence, what we're trying to achieve here is mitigate the risk associated with developing any natural resource asset. If I was to give you a percentage, I misquoted it earlier a while ago, but it's actually 0.07%. 0.07% is the probability of actually getting from identifying a greenfield mineral resource all the way out to getting what we call an economic study. That's not, developing it, that's not bringing it into production, that's not bringing it to profitability. There are some still more risks associated with that. And that risk is basically only halfway there. You've still got another 5 years to develop it and financing. And those risks consist of geological risks, metallurgical risks, mining risks. You then, in addition to that, you will have some economic risks around that. And those are the ones that you can control. And that's where we try and focus our efforts on identifying assets that have very low risk profiles across the board. And we also and then you have these existential risks that come along with that. After that, you'll have commodity risk, you'll have environmental, legislative, and country risk. So by first of all identifying the right assets and getting past that less than 1 in 1,000 chance to get an economic study, which, by the way, all of our projects, bar one, which I'll talk about later on, have achieved. And then it's getting involved with the management team. So for the last 2 or 3 years, we've been actively involved in the management team. So we spend a lot of time. We don't just deploy cash. We then actually spend a lot of time being involved in developing these assets or helping drive those assets to a fruition or an exit once we've reached an optimal valuation. So I think, some people say, oh, that's very well and good. So what are your returns? Let's look at our returns on our public side. So we have really two sides. We have the public investments and there are private investments. And if we look at, our returns on public investments, overall, 2020 was a great year. But overall, we've been sitting around over the last 4 years in the region of around 300%. Over that period of time, and the year to date in our investments to 2020, we're up by 18.5%, and that's in our public investments. That we don't have as much involvement. What we tend to do is sit on the boards, but we are usually a minority shareholder. But our private investments, and this is where we've had two sort of important ones where we can actually see and crystallize those values. You can see those values. Is our Amapa iron ore investment, which you have heard of. It was a legal process, oddly, it was a judicial recovery in Brazil and spent 2 years involved in that. That's allowed us to get 27% for 6 million. And the previous value, when it was owned by Anglo American, valued it at 660 million. So, grossing that, if we were able to achieve that sort of valuation, we'd be looking to, be able to achieve a multiple return of $178 million in terms of that valuation of our 27%. And then lithium technologies, this is one of the assets that I said hadn't really, was much earlier stage, and we divested that risk. Eventually, we basically said, look, we had a book value of a small stake, and then we've got a conditional sale agreement that's occurring, which will value it up to 3.72 million, with the upside, because we have equity in the company that's bought it, with the upside should the exploration be successful. So the summary of investments, this is across the board, and we are an investment company on AIM, and we have both lithium, rare earth assets, and iron ore. The focus for lithium, as we probably all know, is the focus on electrification of vehicles. Rare earth assets are, of course, in particular in neodymium. These are rare earths that are used in the manufacture of permanent magnets, again in electric vehicles. Iron ore, well, fundamentally, it is also utilised, and we see a considerable expansion there in the iron ore market going forward, and it's performed very well to date. So the ones in black, for clarity, are those ones which are not in the public domain. The ones where we have, let's call it, a great deal of control in terms of how we deal with it, we call it negative control, are in our Mapa iron ore asset. This one, obviously, we've just recently spun out. And these ones, we have JVs of Yangibana Rare Earth and Mexlit, those two JV areas. Where there, we have JVs in 30% of those, but that's only going to be mined in the latter end of the mine life of those two. But as you can see, they're substantial lithium assets. And certainly we would look to specifically Yangibana Rare Earth, is look to convert, as we've done with Synergy, convert that JV into equity into Hastings Technology Metals, which is the owner of Yangibana. And we have 8.2% of European Metals holding in Czech Republic, and that's a public company. So let's look at particularly our iron ore assets, and particularly we're going to focus on Amapa. Now, Amapa, if those have been following the story, it was in what we call a judicial recovery process, which is a structured, almost equivalent of a Chapter 11 in America, where we basically we basically invested in that, took the risk on the basis of the outcome, on the basis of that, it would be successful and it would be restructured. We restructured all the creditors, both the secured and unsecured creditors, to within about 35 cents in the dollar, because we saw technically this asset was highly viable. It's already got a resource, so remember all those risks I talk about, mitigate it. It has already got an infrastructure. That infrastructure, if we were to think about building this mine and putting that infrastructure, including a rail and port, we're talking in the order of about $1 billion to $1.5 billion of capital expenditure required. And because it is reinvigorating this asset, there's going to be nowhere near the amount of capital required to get that back up into operation. We've got our 27%, as we've just made, for $6 million, and our first right of refusal to go to 49%. Reason why we don't go above 49% is then we would become an operating company and having to do a full reverse takeover in the United Kingdom, which is not what we really want to do at this point in time. So you can see Anglo American held at 660. Annual operating profit at the time was 2012 was $171 million per year. It's a resource of 14-year mine life. I'll talk about one of our targets later on is to try and increase that by about 5 to 10 years, hopefully. So when we talk about risk, well, all that I talk about, those first 5 years, that 1 in 1,000 chance, we've gone through. There's a JORC resource statement. We know the mining technique. We know what that's going to cost roughly. We know what the processing, the risk of understanding that product. Are we going to be able to produce a product that someone wants? Yes, we're going to be producing a 65% iron ore material, which is a higher grade material. We've got the railway transporting, we've got the ship loading, and we actually know how to take it to China. But all of that infrastructure, geology, mining, processing, rail, and port, belongs to Amapa, and we have 27% of that. We believe that our OPEX and G&A will be about $35 a ton to get it to that port, and then probably, depending where shipping ends up, but probably another $30 to $35 to take it from there to China, being the easiest and most sensible market to sell our 65%. 65% FE sells around about $170 a ton at this point in time, probably a bit more, $180. I used to have the capital expenditure. There was a capital expenditure in there, and that was from a 2019 study. We're embarking on our pre-feasibility study, which is going as planned and on target. And that number is coming into sight, and once we get that, we expect to be able to announce the PFS around the July time, probably tail end of July. And that will give an economic value of the future cash flows, and therefore a very clear value of what our 27% could be worth. And as I said, it's got a 14-year mine life. We certainly want to look to expand it over and above that to maybe a 20 to 25-year mine life, but let's see how that goes. So I think this is an idea of timeline. I do grey these bits out here, both there and there. That's because anyone that says that they know when the mine's going to come into production, if they haven't got a pre-feasibility study, it's not feasible really, because you only know your implementation studies, your implementation that you can do all this engineering and all that work really at the tail end of your feasibility study, with a degree of confidence at the end of pre-feasibility study. So you can see we've vested our 27%. We're going to probably, within H2, understand how much it's going to cost us to get to 49%. I believe that will be another $24 million or thereabouts. Iron ore shipments, we have iron ore already there. That is, one of the targets is we'll restart that shipping again. And that's used to pay the secured bank creditors. Pre-feasibility study, look at a mineral resource expansion, and then reconstruction around, again, in the grade area. I think the biggest impediment always to these projects is project financing and financing risk, because they can be capital intensive. So I've rushed through, I hope I've given enough on lithium and on iron ore. We're going to go into lithium and rare earth investments that we have at the moment. I think this is one thing to know, and lots of people have been talking about the price of lithium carbonate. I mean, lithium carbonate and lithium hydroxide, this is from Benchmark Minerals, are effectively the two compounds that are utilized to make lithium-ion batteries. All of our investments were using around $11,000 or to $17,000 a ton lithium in terms of MPVs. Pricing at the moment is around $40,000 to $45,000. I'm sure it will come down, but at this point in time, basically, the world has ignored investing in lithium mines, and hence, that's where we are. We're shorted of lithium carbonate and lithium hydroxide. And it's astounding. I was at Benchmark Minerals' presentation in Berlin, and still the same story is the same. No one's really invested. Everyone's invested in batteries, battery technology, gigafactories, but no one's put the capital into the mines. So just to deal with what we talked about, one of the assets that we hadn't got all the way, it was a very early investment, and it hadn't really done any drill holes. It faced all those risks that I talked about. So our decision, rather than invest capital in that and face those risks, was effectively to take our 31% that we take it, sell it in cash and in shares, repaying back our money that we've invested, and we have shares in the new company, which if they're successful, will increase and will generate more value to our shareholders. Now, it's right next to Core Lithium's asset, which they discovered a fairly substantial lithium deposit, and I think its market cap's around $2 billion. So it's near it. I'm a geologist background. What do all these things mean? Well, it means that there's some good geochemical and geophysical signatures there. So it's got some prospect of having a good chance of discovering a pegmatite vein. Whether it's economic again, that's all about the risk. But we've already got our money back, so that's been, we've only got upside from here. And then I'll talk about European Metals Holdings. Look, we've been with this since early, before it was even a resource. It was a tin asset. And it is one of the largest hard rock deposits in the world. It's listed on AIM, and it's done very well for us. And I think that's delivered about 300% return in terms of our investments. We've been involved in it since pre-resource. We did our due diligence. We understand it. I'm a board member of European Metals Holding and a board member of the subsidiary. So when we look at this asset, I think Europe does about 50. Just to give you a concept, Europe produces about 15 million cars a year, or sells about 15 million cars a year. If we assume 100% penetration in a few years' time, you will need 30 of these deposits to supply. And this is, this type of production of, 29,000 tons per annum of lithium hydroxide to provide. You need 30 of these type of deposits to provide the lithium just for European car manufacturer. And there's only one in Europe at this point in time, and there are probably some others, but this is a behemoth. This has got a 25-year mine life, and that 7.39 million tons of LCE has probably got another 60 years of life in it. It is a huge asset. And it's being developed by European Metals and ČEZ, which is the utility, Czech Republic, which is the utility provider in Czech Republic. They're also going to do a battery plant there as well. An excellent asset, and we retain 8.3% of that. Yangibana, rare earth. This is not rare earth. This is rare earth minerals, and it is really the reason why I've always liked this is because it's got neodymium. Neodymium is primarily utilized in the permanent magnets of electric vehicles. Again, we took this when it was really just early stage. We've been a JV partner all the way along. Haven't had to fund it because our structure is basically a non-contributory JV unless they go to bankable feasibility study on our area. The problem is, of course, that our area only really gets mined in years 10 and 12, or post years 10. This doesn't create a great NPV for us now and value to our shareholding right now. So we'll be looking to trade that effectively into stock of Hastings Technology Minerals, if at all possible. But that's a way to create value to us now and be exposed to it as a public company. And it's, again, it's all that bankable feasibility. It's considerably de-risked. It's got funding from the Australian government for a large chunk of that capex. I think they've already got $300 million of that capital cost sorted. And our last one, a lot of people talk about this. We were invested with a company called Bacanora Minerals. We've got 30% of a JV, again, tail end of the mine life. Haven't had to contribute anything for the last 4 to 5 years, and only the initial exploration work in I think 2015 or 2013. Again, a multi-generation deposit. It's huge. Cost structure is $3,400. Remember, we had $40,000 a ton lithium carbonate beforehand. It's now been bought out. The public company of Bacanora has been bought out by Ganfeng Lithium, which is the third largest lithium compound producer in the world. 8.8 million tons, again, a very large deposit. Our area is a 30% JV, mined in the tail end of the life. I think there are some political issues within Mexico at the moment that hopefully should be resolved. And that certainly looks like that Ganfeng will look to develop that asset as quick as possible as part of their strategy to provide all the lithium that needs to be done for the electric vehicle market. So, I've gone through the reason why you should, the summary of what we've done, but I think the targets for us are important. Our targets in the short term are restart the export of the iron ore stockpiles. That's important to repay the bank creditors. Defy the value of the remaining 22% first right of refusal. Completion of the pre-feasibility study. Expand our resource target to another 5 to 10 years. And try and find some more value creation from our non-core assets, in particular, the Hastings Technology Metals one. So, those are targets. We've hit some of the targets that I said at the beginning of the year. So let's hope we can, we're aiming very firmly to do those during the course of this year. Thank you, and I think I've got a bit more time. I've rattled through that, so I've got a bit more time for questions, I think.
Thank you very much. Any questions, please raise your hand for Kiran. Come to you. Chris, thank you.
Is there any iron ore left at the port in Amapa? We've sent half a dozen or a dozen ships out already to China. Is there anything left?
Yes, so there's two parts to that. It's a good question because as part of the historic settlement, there's lots of piles of 65% iron ore, which doesn't belong to Dev Minasang. And that has been shipped out by us at cost plus some profit. So Dev is shipping that as part of profit. It's a 65% material, and our materials are 58%. So the margins are much larger. So that was part of the deal. We need to ship that out. Actually, Dev has actually only shipped out 3 ships so far, and that was at the beginning of last year. Yeah. So we've only done 3 ships. I will always tell people when I'm starting to ship again, and that's the target, is to ship. The other ships will all belong to a previous creditor that was settled in the JRP. Okay.
Kiran, I had a couple of questions on Ampara. You're at 27%. Is it your intention to take it up to 49% ownership?
It's a first right of refusal, so it's up to the other side to call on that. And at this point in time, if there's opportunity and the price is right, yes, we would go increase that percentage appropriately.
And how would the valuation be calculated at that? Would it be the valuation at that time, or is there any sort of methodology to this?
It's a negotiation which we're in the middle of. So I've been talking about, it's about $20 to $30 million for that 22. So I sort of mentioned $24 million, about right. So basically, if you talk about it, our total contribution, if we were settled that, would be $30 million for 49%, valuing the whole asset around 60 million as opposed to 60 million as opposed to 660 million. So it's still a very good value investment. And by that time, you would even further de-risk it, right? You'll be down the environmental licenses, all of these things because of the way the asset is and what the asset is. We've de-risked a lot of those aspects that come along with developing a new asset.
Any other questions for Kiran, please? I was going to hold this if that's all right.
Kind of missed it. The Yangibana one, right, where are you taking that out from, Carnarvon or Broome?
Well, it hasn't even started. I'll just show you. I think they're looking to take it out from Broome at the moment. Okay, it's not us, to be clear, it's our JV partner who will be doing that, and that's their intent.
I had a further question. What's your appetite for further investments? Are there any particular assets that would complement the portfolio? Could you have the capacity to take on more?
I think our shareholders want to see some delivery on these. We've delivered some more, so let's deliver some of those and see an appreciation in our share price. We do have a sort of a portfolio as well of small investments, which are sub £200,000 that have sort of contributed to 100% returns, and we'll make those and we'll disclose that at the end of each quarter. But if we're talking substantial, not in the short term, no.
Any other final questions for Kiran, please? Anybody? I've got one final one then, if I may. At the moment, you're an investment company. Do you have an appetite to become an operating company?
At this point in time, we're staying as an investment company. It really depends on if we want to talk about exit strategies. What is the exit strategy here, right? Ultimately, do both partners have enough money to fund this out and build it themselves, and put the equity in? And if so, does it better to have one entity listed? It might not even be, in Cadence, we might just spin that out into a new entity and we still retain our percentage with new shareholders. I think our investment, staying as an investment company at the moment is our plan, because it allows us this nimbleness to get out and get in. And, our strategy very much has been and will be, especially in these private assets, is to act more like private equity than just in passive investors, which has been our strategy. But for the last 3 years, we really want to get involved in the asset, act as JV partners. Through our JVs, have sort of a form of negative control, where although we don't exert complete control, we have a control on the purse strings, we have a control how the asset's developed. Even though we might only have 27%, we're acting as effectively 50-50 JV partners.
I'm with you. Okay. Well, Kiran, thank you very much indeed. Thank you for presenting this evening.
Thank you.